Well, hello and a very warm welcome to this webinar, Big Beautiful Bill, Implications for the US Sovereign Rating, brought to you by Scope Ratings. It's my pleasure to be your moderator today. I'm delighted to be joined by Alvise, Lennkh-Yunus and Eiko Sievert from Scope's Sovereign and Public Sector team. Gentlemen, good afternoon. Nice to see you. Now, in a moment, Alvise and Eiko will run you through a short presentation covering a brief history of Scope's US sovereign rating, their thoughts on the state of US public finances and how this signature bill plays into those, and then some checks and balances. After the presentation, we'll move to Q&A, and we'll be delighted to take your questions. So please type these in to the questions function as we go along, and we'll get to them later. And please note that today's presentation will be downloadable at the end of the session. All things being equal, I'll explain how to do that later. So that's it from me. Thanks for your time today, gentlemen. We've got a lot to get through, so let's jump straight in. I believe you're going to start, Eiko, so let me hand over the floor to you.
Yes, that's right. Thank you, Keith. So good afternoon, everyone, and great that you're able to join us today. Most of you will, of course, have already heard of the so-called Big Beautiful Bill, which was signed into law by President Trump on the 4th of July. And given the long-term implications of this legislation, we wanted to take a closer look today at what it all means for the US sovereign rating. And it is certainly worth taking a closer look, since many numbers that have been quoted over the past couple of weeks are normally in the trillions of US dollars. So in the next few slides, we'll first start with an overview of where Scope sees the US sovereign rating at the moment. And this includes a quick run through of the main triggers that could push the rating or outlooks either higher or lower. I will then dive a little bit deeper into the state of US public finances. So this includes a recap of what was actually agreed under the Big Beautiful Bill and how this will impact US government deficits and debt levels going forward. I'll also touch on the sort of broader US fiscal position, including the impact of higher expected tariff revenues. And I'll illustrate a couple of scenarios to show what would be needed to stabilize the US debt to GDP ratio over the next few years. My colleague Alvise will then highlight several other important factors being considered in our sovereign rating analysis for the US. And this includes, for example, an update of where we stand with the US debt ceiling, which was also increased significantly as part of the Big Beautiful Bill. And he will also highlight key governance risks, including related to the Federal Reserve and the importance of the US dollar's role as a global reserve currency. So let me start with an overview of the US sovereign rating. On this chart, you can see how our rating compares to that of the major US agencies. And as you can see, we've had a more negative view on the US for many years, with the sovereign rating at least one notch lower than the US rating agencies. You can clearly see that there have been several negative rating actions taken by the US agencies over the past 2 years, bringing their rating somewhat closer to ours. An important reason for our lower rating has been the role of the US debt ceiling and the increased cases of political brinkmanship we have seen over several years now. But I don't want to get ahead. There will be more about this topic later in the presentation as well. We currently rate the US at a AA level with a negative outlook. And we assigned the negative outlook in June 2023. And key reasons for this negative outlook were first the recurrent risk associated with the debt ceiling. Then second, the long run rise in political polarization that we've been seeing, and also the continued weakening of government finances. And because of the sharp policy shifts in the US in recent months, we affirmed the negative outlook in May this year to also reflect the deepening institutional and policy uncertainty. What I also show here are the key drivers that could either result in a downgrade of the sovereign rating or a stabilization of the outlook. So I don't want to run through all of these in detail. You're welcome to read them on our website anytime, of course. But perhaps to give you the highlights on the downside scenarios. So these include first, if we see a continued policy uncertainty, for example, in the form of unresolved trade negotiations, or second, if the weakening of public finances continues. I'll discuss more of this in the next couple of slides in much more detail. Then third, if there is a substantial weakening in the well-established checks and balances, which Alvise will also touch on later. And this also considers, of course, the political pressure on the Federal Reserve. And then fourth and fifth, this basically is if there was a prolonged debt crisis or a diminishing role of the US dollar as a primary global reserve currency. But also more on this later in the presentation. I won't go through the upside scenarios for now, and not because I think these won't happen, but because to a degree, they are mirror images of the downside scenarios, really. So yeah, let me move straight into the state of public finances first. So unsurprisingly, we have to start with the Big Beautiful Bill. And over a 10-year period, the broad legislative changes are expected to raise the fiscal deficit by around 3.3 trillion US dollars. So that's around 11% of GDP in 2024 terms. The bill includes both significant spending cuts, but also clearly spending increases. The spending cuts are shown in the red on the left-hand chart. And they include, for example, more than 1 trillion US dollars in cuts to healthcare provisions. This mainly relates to eligibility changes to Medicaid, which provides health coverage to many Americans, including eligible low-income adults or other vulnerable groups. Around 700 billion US dollars to repeal and reform various tax credits. This includes changes to tax credits under the Inflation Reduction Act. So for example, for electric vehicles or for energy investments. It also includes various other changes, such as imposing a floor on charitable donations or abolishing previous provisions that allowed sort of low value shipments of less than 800 US dollars to enter the US duty-free. So it's quite a mix of changes included here. And then another around 280 billion US dollars of various health, education, labor, and pension policy changes. And this particularly includes changes to student loan repayment plans as well. However, these cuts are more than offset by the extension and expansion of the tax cuts that President Trump introduced during his first term. And this alone raises the deficit over a 10-year period by more than 4.6 trillion US dollars. And that's a big blue bar in the middle that you see. The deficit is further increased by additional new tax cuts of around $700 billion and additional funds for the armed services, homeland security, and the judiciary. As you can see on the right-hand chart, if we first of all add interest to this higher primary deficit and also assume that the tax cuts that are being made are made permanent, then we quickly end up at a much higher number of around 5.5 trillion US dollars over the next 10 years, or almost 19% of GDP in 2024 terms. One important note here is clearly if Republicans had not extended the 2017 tax cuts, it would have resulted in a very substantial tax increase that would have significantly dampened economic growth. And therefore, we assume that this will also be the case going forward, so that tax cuts made under the current bill will simply be extended in later years. So how do these higher deficits fit into the broader fiscal picture of the US? So with this slide, I want to illustrate some of the rising fiscal challenges facing the US. Even with its large economy and reserve currency status, the US is increasingly constrained by structural budget imbalances, and in particular, rising interest costs. So let's start with the chart on the left. So this shows the US primary headline fiscal balances as a share of GDP over time. As you can see, the US has run consistent deficits, both before and after interest payments. The interest payments are shown by the yellow bars. And we are expecting primary deficits and these high interest costs to keep weighing on the US fiscal outlook, with headline deficits averaging around 6% of GDP over the next 5 years. The chart on the right illustrates long-term structural pressures in the US, especially over the sort of next 2 to 3 decades. And an important point to note is the expected rise in net interest expenditure, which is shown at the bottom in orange. This made up around 14% of the federal budget last year. And estimates by the Congressional Budget Office indicate that this share will gradually rise to around 20% of the budget. And clearly there is a degree of uncertainty here, but fundamentally this increase is driven by the high level of debt in the US, which is expected to keep rising, and the higher interest expenses following the period of very low interest rates after the global financial crisis in 2008. And programs that tend to be politically difficult to cut, and that also caused actually quite a lot of debate within the Republican Party as the Big Beautiful Bill went through the Senate and the House, are first of all Social Security, second Medicare, and third Medicaid. And in total, these three blocks are expected to make up around 53% of the government spending by 2037, and then onwards. That's up from about 47% today. And particularly Medicare expenditure is driving this growth as the population ages. And then finally, this leaves the discretionary spending block, shown in yellow at the top. So this refers to spending by the federal government that is approved by Congress annually through the appropriations process. And it includes spending items such as education, transportation, scientific research, environmental protection, and sort of many other government operations. And in particular, it also includes national defense, which is by far the biggest item in this category, and made up about 13% of the budget in fiscal year 2025. And as a share of the total budget, discretionary spending in total, so including the military spending, is expected to decline from around 26% today to around 20% in the next 1.5 decades. And we can assume that military spending will remain high over this period, so the spending flexibility for other programs will become increasingly squeezed over the next years. But let me turn back to the sort of 5-year horizon rather than the 2 to 3 decade horizon. And here it seems that if the US really wanted to materially reduce its deficit, we would need to see either higher revenues, for example, through higher taxes, or politically painful cuts to entitlements or military outlays. And then there is, of course, also one other way to raise revenues, and that is through higher tariffs. So while there is unsurprising frustration among countries facing higher US import tariff rates, from a US perspective, it does raise additional revenues for the government. And we are all very familiar with the highly volatile tariff policy of President Trump. And even when agreements are made, there's sort of non-negligible chance that existing tariffs are suddenly changed or new ones are suddenly introduced. So even when tariff rates are eventually set for individual countries, and of course then also implemented, we can continue to see changes in sector-specific tariffs, for example, in autos, in chemicals, in pharmaceuticals. And that's especially the case if trade imbalances do not evolve in a way envisaged by the US administration. What we can observe is that the average US tariff rate on all imports is seeing its steepest rise for at least a century. You can clearly see this in the left-hand chart. From a budget perspective, the higher tariffs are leading to significantly higher revenues for the US. So in the right-hand chart, you can see that monthly tariff revenues increased during Trump's first presidency, which you can see after a long period of lower tariff revenues. But this jumped a lot more significantly during Trump's second term, rising to 22 billion in May and to even 27 billion in June, if we look at the latest data. And clearly there is a high degree of uncertainty where we actually land in terms of annual tariff revenues over the next few years. And it really depends not just on the final US tariff rates, but also on the impact on trade flows from retaliatory tariffs as well, and demand elasticities for individual goods being imported into the US. At the moment, we estimate tariff revenues above 250 billion every year over the next 5 years. And of course, there is always a question of who actually pays these tariffs. It's true, part of the costs will be absorbed by exporters who may reduce their profit margins somewhat. Another part would be absorbed by US-based importers who may also lower their profit margins. But the majority, and by some estimates, so 70% of the tariff costs is likely to be absorbed by consumers. And in that sense, the higher tariffs are not that dissimilar from a tax hike. Let me now turn to what all of this means for the US debt trajectory. So one point I want to note before I speak about the three scenarios shown on the left-hand chart is that the debt to GDP ratio in the US is currently near its highest level since the Second World War. It increased quite sharply since the global financial crisis and has not really recovered since then. And the chart on the left shows three scenarios that all incorporate, first of all, the higher fiscal deficits from the Big Beautiful Bill, and also the higher expected tariff revenues. And under our baseline scenario, the debt to GDP ratio would increase to around 127%. If we compare this to other large sovereigns, the US debt level would sit in between Italy, which is expected to be at 137% by 2030. And Italy is currently rated BBB plus stable by Scope, and between France at 122%, which is currently rated AA minus stable by Scope. One point often made by US politicians is that the policies introduced by President Trump will significantly increase economic growth. Medium-term growth since the 2008 financial crisis, if I now exclude the sort of crisis years, 2008, 2009, and then also 2020 and 2021, averaged around 2.5% per year. We currently forecast around 1.8% growth for 2025 and 2026. Clearly, these estimates are still relatively volatile given the policy uncertainty. And it is true that there is some upside potential. So, for example, if sharp deregulation across sectors results in higher economic growth, also the leading role of the US in artificial intelligence could support economic growth and efficiencies in the next couple of years. So if we therefore assume that a scenario where the US is able to achieve 3% economic growth every year starting next year, so that's well above the historical average, this could be enough to stabilize the debt trajectory as shown by the yellow line in the chart. If in addition to higher growth, the US faced higher inflation of around 3%, so staying above the Fed's target, then it could even lead to a slight decline in the debt ratio. But still, we have to keep in mind here that none of these scenarios expect any major external shock. And if I look at the geopolitical developments these days, this looks like an optimistic assumption. It would therefore be important that there's a stronger focus from all political parties, really, to reduce the debt burden in the United States. A final point I wanted to make here is illustrated by the chart on the right. This just shows the net interest payments as a share of government revenues. As you can see, the US is certainly not alone in facing a rising interest payment burden, but the rise has been significantly sharper in the US, reflecting a relatively short-term debt maturity, also the high debt level and the higher interest rates in the US following the low interest period after the 2008 financial crisis. With that, I would hand over to my colleague Alvise to just say a few words about the checks and balances in the US and how these are also relevant for the rating. And of course, we are very happy to take questions at the end as well.
Many thanks, Eiko. So as Eiko just said, we'll dig into some of the wider implications of the Big Beautiful Bill on governance issues. So a key reason that we rate the United States at a AA level is its relatively flawed or incomplete fiscal framework, specifically because of the recurring risk of the so-called debt ceiling crisis. As you know, the debt ceiling actually limits the amount that the US Treasury can raise. So it's supposed to act as as a tool to induce fiscal restraint. But in practice, this does not happen. In practice, the debt ceiling is being misused by policymakers who use the threat of default to extract political concessions from the opposing party, which is why, in our view, the US fiscal framework is a key credit weakness. Now, the big, beautiful bill has again lifted the US debt ceiling by another 5 trillion, so to a limit of 41 trillion, which is a debt level that we expect will be reached by the year 2027 or latest beginning of 2028, given the fiscal pressures that Eiko has just laid out. So in the near term, the pressures and risks of another debt ceiling crisis have eased with the bill, but they're not addressed or eliminated in any way. Now, whether these risks will then return at the end of 2027 or the beginning of 2028 actually depends on the midterms. And here, there's obviously a lot of uncertainty at the moment. It's still very early days. We still have 15, 16 months to go to the midterms. But at least based on current pollings, it seems that there's a very open question as regards who wins the House. So I think the House, it could remain under Republican control, but Democrats could also flip it. It's really uncertain at the moment. As regards the Senate again is currently also under Republican control, but here too, at least given current projections, it seems more likely that the Senate will remain under Republican control, even though more seats are up for more seats are being contested that are actually under Republican hands. A big unknown, which is very relevant for the outcome of the midterms, is the relevance and impact of the new America Party founded by Elon Musk. It's very unclear at this stage whether this party will have an impact on the electoral outcome and whether it actually becomes the kingmaker that the founder would like it to be. From a credit perspective, and we're talking about checks and balances, from a credit perspective, a split Congress would actually have mixed implications, we believe. It would, on the one hand, certainly increase checks and balances. I mean, a split Congress usually does that. You would have certainly the checks and balances, but then also the associated risk of legislative gridlock. On the other hand, however, when it comes to the debt ceiling, the risk of a debt ceiling crisis would certainly increase substantially at the point in time when the debt ceiling is reached, which would again be around the end of 2027. And that in the current political environment, this would be quite credit negative. So that's so just to summarize here, the impact of the big beautiful bill, it eases near-term pressures on the debt ceiling, but it doesn't eliminate them. And there's a good chance that after the midterms, again, depending on whether there will be a split Congress, this risk and uncertainty could re-emerge. The other significant institutional anchor of the United States has been the independence of the Federal Reserve. We've all seen the vocal attacks from President Trump on Fed Chairman Powell to lower rates sooner and faster. The fact is, however, that inflation remains above target. Even though it's declining, it still remains above the Fed's target, and with significant uncertainty, not least from the actual policies of the administration, which tend to be inflationary. So the fiscal policy, the trade policy, immigration policy, all of these policies, the impact thereof, it still needs to play out. And and they are all likely to be somewhat inflationary. So from that point of view, it very much remains to be seen at what pace the Fed will lower rates. However, given the political pressure on the Fed, from a governance point of view, for us, a key question is also whether the Fed can remain independent when Chairman Powell's term ends. And here, our baseline is yes. And this is even if there were to be a shadow Fed chairman who would be announced early, who, based on his or her track record, would have an inclination to lower rates. And the reason is twofold. One is whoever Trump picks as successor of Powell, it needs to be confirmed by the Senate. And even though the Senate is Republican, we would still argue that the majority of the Senate would want to pick and choose someone who has a credible track record. So not any nominee is likely to pass the Senate confirmation. The other element actually has to do with the governance of the Fed, and specifically the Open Market Committee, which consists of 12 people, not just one chairman. So even though the appointment of the chairman is very visible, the actual governance of the Fed system is such that it's a 12-person committee that needs to decide on rates and monetary policy in general. So there are certainly safeguards in place, even if the headlines are quite visible that the Fed's governance and independence is under attack. But still, this president is very vocal, and we will need to see whether the FOMC responds to direct political pressure or not. Certainly, what happens, or let's say a structural pressure that continues to rise, is the risk of fiscal dominance. And here, as Eiko has said, I mean, the rising fiscal pressures will continue to increase pressure on the Fed to ultimately engineer financial repression if the inflation outlook remains above target. So this is certainly a risk that we see, and it's one that we will certainly monitor very, very closely. But for now, our baseline is that the Fed's independence, its governance structure, and committee structure will remain very much independent from any personal attacks. Finally, a huge check and balance, and clearly a key supporting factor for our U.S. credit rating is the role of the U.S. dollar as the world's reserve currency. Will the bill have any impact on the status of the U.S. dollar? It's frankly hard to say. Because in a way, it also depends on the extent to which the bill actually raises the risk premium on U.S. government debt over the medium term. In the current context, however, it cannot be ignored, especially given the additional unorthodox policies of the Trump administration. So we would argue that there's currently no doubt that the US dollar remains the primary reserve currency. We do observe a gradual decline in the use of the dollar as a foreign exchange reserve. This has happened already before. I mean, this is a gradual process. It's happened over the past 10, 15 years. And it is gradual also because there are no clear alternatives, including from the euro or the Chinese renminbi. But we do see that investors are looking to diversify their US dollar exposure. We see this in the rising share of other reserve currencies. That's the yellow bar at the very top. And we also see it in the increased demand for gold in recent quarters and months especially. So the desire to diversify away from the dollar is present. But so far, surely a gradual process. Clearly, the treasuries can still count on global investors to buy its debt, and that's why the US has the greatest fiscal space among sovereign peers. But we would argue that even for the United States, the fiscal space has its limits, as investor sentiment can change. We've seen that, which is why ultimately investors are the ultimate check and balance on the US policy. It's just that no one knows in advance where and when that limit is really reached. So this is clearly something for us also to watch. But I think overall, I think it's fair to say that the latest development, the latest decisions by the Trump administration add pressure to the fiscal dynamics. And in the context of the other policy decisions and proposals, it's one that we are worried about, notwithstanding all the checks and balances in place. So with that, Keith, we hand over to you.
Great. Thank you very much there, Alvise and Eiko. Some fascinating topics in play there. But look, I've just got a few questions I wanted to put to you most of, but you've touched on elements of most of them, but if you have discussed it, perhaps you can just recap. So look, if you kind of look at the kind of media scope and the blogosphere and social media sphere, there's a lot of naysayers out there about President Trump's policy approach and policies. So the question, I guess, is perhaps maybe cuts across some of that, is what do you think the chances are that President Trump's unorthodox policies are successful for US growth and the fiscal trajectory?
Maybe I start on this one, and Alvise, feel free to obviously comment as well. But so I think in terms of, yes, you're right that there are a lot of sort of negative headlines when it comes to Trump, and plenty of pessimistic reading that you can find. But it's certainly not impossible to generate stronger growth in the US, and that can, as I showed in one of the scenarios, can help to stabilize the debt trajectory. Although the challenge is quite big, I would say. So when Trump initially introduced his tax cuts in 2017, so it did give a small boost to economic growth in the sort of 3 years leading up to the pandemic-induced recession that we saw. But growth did stay below 3% during those 3 years. So that's below the scenario that we had. So to achieve this higher level, so first of all, from the current Big Beautiful Bill, many of these tax cuts were simply extended. So there's not really a new impulse, but just an extension of a past impulse, really. So to achieve the higher growth, I would say we would need to rely on, first of all, deregulation, and then also on sort of efficiency gains from the use of artificial intelligence. And there are, of course, sort of medium-term risks that are also associated with sort of large-scale deregulation. And it could result in sort of gradually growing imbalances across many different sectors. So financial sector, of course, but many other sectors as well. And ultimately, that could lay the sort of foundation for future crises. These probably wouldn't happen during Trump's term. So during Trump's term, we would then see a slightly stronger growth, but they could come to haunt the US in future years. On tariff revenues, so it's still quite difficult to accurately assess where we land in terms of revenue streams here. We'll hopefully know a bit more in the next few months when more of the trade negotiations are settled, but there will remain a degree of uncertainty anyway, and we really have to see what this does to global supply chains, and also in terms of retaliatory tariffs, to see how much revenue the US can really extract from this. And ultimately, as mentioned, much of this is essentially paid by the US consumer. And if that's the case, then that is essentially a tax increase, which will then dampen growth again. So the dynamics are quite complex, and it's not very clear that there's an obvious path where we will see significantly stronger growth that is big enough to really tackle or deflate this debt mountain that we have at the moment. Yeah.
Okay.
I'd leave it at that.
Alvise, feel free to add anything to what Eiko said, but perhaps I could ask another question, which you kind of touched on sort of laterally, but fascinatingly, when you made reference to the midterms. And I guess my question is, could a change in administration dramatically shift US fiscal direction? I know we're out in the realm of speculation here, but perhaps you can lay down some just broad thoughts.
Sure. I mean, the administration will stay until 2028. I think in terms of the fiscal outlook, even I think it became clear during the last campaign between Harris and Trump that neither political party is actually even thinking about fiscal consolidation in any meaningful way. So I think obviously the Big Beautiful Bill is accelerating the fiscal deterioration and the fiscal dynamics, but it's not like any US politician has made any effort to communicate the need to consolidate fiscally. And so even if looking beyond 2028, at least today, it seems unlikely that an administration would emerge that would want to rein in the expenditures. And this also goes to the point that the slide that Eiko had on the increase of the structural spending pressures. These are all, I mean, the increase in expenditure between today and the next 10 years, 90% of that is interest and social expenditure, and that's politically. So the social expenditure is politically very difficult to touch. So we wouldn't, unless forced, and that's a question then for which would ultimately be with the reassessment of risk by financial markets. We wouldn't expect another administration to really dramatically change fiscal course.
Yeah. No, indeed. Okay. Yeah, makes sense. And look, the other thing that's on my list here is this political brinkmanship came up in regards to the debt ceiling. Perhaps can you quantify the degree of concern that you have about political brinkmanship once the new debt ceiling limit's been reached? And if the debt ceiling were eliminated, what impact would that have on the US sovereign rating? No, I'm sorry, you can't think too much about the rating, but perhaps, yeah, just in those terms.
So it's tricky because the peaks of the debt ceiling crises so far were always when there was a democratic president and a Republican House. This time it would be the other way around. So there is no real precedent. But given the political environment, it seems that there is certainly a risk of a sustained standoff, and again, depending on how the midterms go. So I think the risk is of sustained market uncertainty is significant. And again, it's not the debt ceiling itself is there to limit fiscal restraint, but it's not happening. It's actually, given the polarized environment, it's being misused. And that speaks to your second question on what would happen if it were eliminated. Well, if it were eliminated, then the US would have no fiscal framework, or hardly. There's no restraint at all. So the question is, can it be replaced? Can it be replaced with another reform? And I mean, there are multiple reform proposals out there that would induce such a change, which we would assess as depending on the details, etc., as positive, because the elimination very much is, it would ease the near-term pressure of a debt ceiling crisis, but it would not address the structural fiscal pressures. What would address the structural fiscal pressures is a credible fiscal framework, and that would need to be implemented. But at the moment, we don't think that there's credible discussions at the political level about this. But yes, it's again it's one of the reasons why we rate the US at a AA. It's exactly this recurring risk. It's the only nation that has that framework that actually induces this risk.
No, for sure. I was going to move on to ask about Europe. I'll do that in a second, but we do have a question. Actually, I was just about to ask our viewers to put their questions in, and one did come in like magic. And the question is this: do we underplay US capabilities of tax increases? And the question says, just consider increased tax on petrol and gasoline to EU level may cut debt in 10 years. Any thoughts, Eiko or Alvise, on that particularly?
Happy to start. So essentially, yes, that's a good point. Compared to European levels, taxes in the US are clearly lower in that sense. And that, in principle, you would think gives a chance to raise revenues. But I think politically, pushing these type of tax increases through would be very difficult, especially when it comes to the spending that we've just mentioned in terms of gas, because that is a price that everyone notices immediately. The price at the pump is basically a political measure of whether a party will get reelected or not. So introducing some of these tax increases is probably very difficult, especially as many Americans or US citizens don't want to see European level taxes. But Alvise, I'm happy for you too.
No, I think so. I think contrary to many other advanced economies, in theory, the US has the space to raise taxes. It's just that, and not just on energy, but it's just politically, it doesn't seem to be a viable path, at least at this point.
And maybe just a final point to add, this to some degree makes a sort of tax increase through the back door in the form of tariffs quite attractive, because politically you can state that foreign countries will be paying this tax, but in reality a lot of US consumers will pay it in the form of higher prices.
Yeah, no, absolutely. Okay, thanks for that. Just wanted to finish, I'm conscious we need to finish in a few minutes, but wanted to finish with a question about Europe, because the comments have been very much focused on the US and perhaps some global issues. But when it comes to these sharp US policy changes, I mean, again, it's a generalized answer, I guess, but what impact will this have on European economies? I mean, that's a question to either of you. So,
as you wish. So happy to go first, and Eiko, please chime in. I think so. That's the key question for Europe, no doubt. I'd say there are probably three channels. One is clearly on trade, with a significant uncertainty. Here, the impact is clearly negative because of trade channels, but especially mostly because of confidence and uncertainty, as well as the impact on the exchange rate. So I think those are probably the main drivers. And the impact for Europe, however, is quite diverse across the member states. So obviously, the more open economies, the ones that have more trade exposure to the US, are more impacted here. So the impact is actually quite uneven across the EU 27. So that's on growth. I think the magnitude, so the impact of the magnitude of the shock clearly depends on the final rates and the counter tariffs if and when they come. But it at least from, yeah, I think that would be the main. I think the clear shock is mostly on confidence and the exchange rate. The other one is the national foreign policy and the withdrawal of unlimited support for NATO, which has obviously sparked. It's been a bit of a wake-up call for Europe to increase its defense expenditure. Here, I think, I mean, obviously the NATO target that was agreed, the 3.5% core military expenditure by 2035. That's the anchor. But we would argue that it's certainly going to affect the large economies, and especially Germany, where we've already seen a revision of the fiscal plan and the funding plan of the sovereign. But we would not necessarily expect the new NATO target to translate necessarily into steep increases in expenditure among those countries that are fiscally constrained, and we've already seen that being communicated by several member states. And again, the target is set until 2035. A lot can happen until then. So I think it's a clear pressure point. But ultimately, the security architecture of Europe is probably comes down to France, the UK, and Germany, less so the smaller member states. And with that, you have we would expect some degree of free riding. Finally, I think this is probably the positive side, is that obviously the Trump administration creates a lot of pressure for Europe to advance its own reforms, the reforms it can control, and the opportunity that brings with it. And there's lots of discussion about deepening the single market, boosting the capital markets union, etc. That's the huge opportunity that Trump actually creates, that he adds pressure for European policymakers to advance these efforts because they control them. And that's and that actually would far outweigh any risks that could come from the tariffs and lower trade with the US. So that's why there are short term clearly pressures, but over the medium term there are also some opportunities, no doubt.
Okay, very good. Eiko, anything to add?
Only a very small point. I mean, Alvise, you've covered it nicely. I mean, Europe is the sum of all of its crises, right? But just on defense spending, I suppose the defense spending argument is not a direct impact from the big beautiful bill, but it is an impact of the structural fiscal pressures that we see in the US. Especially, I showed earlier the chart on discretionary spending and the squeeze that we see on discretionary spending, which includes the military spending for the US. And that medium-term structural pressure is one of the reasons why the US is pushing harder and harder for European countries to step up on military spending.
Yeah, indeed. Good. Okay, thank you for that. We've kind of finished actually bang on time, so I think that I've got no more questions. And so let's finish the session there. I did promise that I would tell you how to download the slides. Now, Livestorm's changed the download function on the platform, but I'm faithfully promised. Now, I can't see it on my view, I'm told, but on your view, if you go to the top right hand of the presentation, there's a download button. And so hopefully that's as I can't see it, but I'm told that's the case. So do download away. And while I do that, I just wanted to thank you, Alvise and Eiko, for your very insightful comments and answering the questions. And thanks in particular to you, our viewers, who tuned in and stayed till the end. I hope you found that useful. Now, clearly, these are big global topics. We're in very fluid situations. Depending on what day of the week it is, we get market volatility, quite sharp in some cases. And as it's a fluid situation, and as appropriate, we will come back with an update on these and related topics at some point, or at the point at which it's appropriate. So look out for those. So in the meantime, I wish you a very successful and fun, if you can, rest of the afternoon. And we will see you next time. So it's goodbye from us.
Thank you.